You as well.
So I'm going to do introductions and make sure that everybody knows who's going to be on the call today. You can feel free to turn your cameras on. I know John likes to see everybody's smiling faces and have those conversations. If you do not want to put your camera on, that is okay as well. But feel free. These are typically webinars where we do a lot of we give a lot of information, but there's a lot of conversation that happens afterwards. So we do a lot of questions and answers. We go through a bunch of scenarios and we're happy to answer those. So sometimes it's easier when your camera's on. But it being 2 minutes past 12 o'clock, we are going to get started. So good afternoon, everybody. My name is Michelle Fitzpatrick. I am joined here by a bunch of colleagues and I'll introduce you, but just one quick housekeeping item before we start, just so you know, this webinar is going to be recorded and it is going to be sent out to everybody who's registered for this session. So if you do not feel comfortable being recorded or being on, just know that you can disconnect now and we'll send you the recording afterwards. Otherwise, you're just consenting to being recorded. So without saying anything more about that, again, my name is Michelle Fitzpatrick. I am with Northern 1031 Exchange. We are a wholly owned subsidiary of Northern Bank. I'm joined here today with John Starling and Sarah Starling. They are out of our North Carolina location and they do our 1031 exchanges. And I'm also joined by Brent Boucher. He is located up here in Woburn with me, and he does our residential mortgages. So John and I are going to kind of tag team the presentation. If you have any questions about lending, they're going to go to Brent. Any questions that you have about 1031 exchanges, John and I will be able to answer those questions. So John, do you want to do a quick introduction of who you are?
Yes, so I've been involved in 1031 exchanges and helping people avoid paying the tax and building their wealth faster for about 25 years now. And started off in a law firm that specialized in real estate, and then retired from that and moved into qualified intermediary work exclusively about 15 years ago. My daughter, Sarah, not pulling a Bill Belichick here, not my wife. My daughter, Sarah, is a certified exchange specialist and has been along with us for now almost 16 years. And so we have a beautiful team. I noticed that Joe DeSalvo is here with us. He's our newest hire for Northern. Michelle was able to recruit Joe, and he's going to be a real asset to the 1031 exchange team, having a lot of experience in commercial brokerage and banking.
Yes, so there are a couple people that I didn't mention, so I didn't realize that Joe was on. I didn't see you, and Kent Fitzpatrick's on. We do some DSTs with Kent, so we have a lot of partners on joining us, and we have a couple of our coordinators. I see Rachel and Sherry on as well. So a bunch of our team members are on here, but we have quite a few people that are realtors. I see some brokers on here. I see some attorneys on here. So let's just dive in and get started. Typically, when we do any sort of 1031 exchange seminar, we always go through the basics. So I want to just give you a really quick rundown of the basics. I'm going to go through the first few slides, telling you the basics of 1031 exchange, and then I'll have John do the deep dive into what a vacation rental is, what qualifies as a vacation rental, and kind of that safe harbor that we discuss around vacation rentals and what the difference between vacation rentals and second homes. So really quick, what is a 1031 exchange? A 1031 exchange is an IRS code, and this is it. It basically says that no gain or loss shall be recognized on exchange of real property that's held for productive use in a trade or business or investment. If the property is exchanged specifically for real property that's held for productive use in a business or trade or investment. So you sell an investment property, you purchase an investment property, you can defer your capital gains taxes. And that's what we do. So as qualified intermediaries, it is a requirement that you have a qualified intermediary whenever you do a 1031 exchange. And that's the service that we provide. As qualified intermediaries, we act as a neutral third party. We facilitate the exchange. We answer all of your questions. We make sure that it's structured properly. And the most important thing we do is we hold the proceeds. So being a bank-owned qualified intermediary, you know that your proceeds in your funds are safe with us. We hold them in segregated subaccounts in your name and in your tax ID number. So those are used specifically for the benefit of purchasing a replacement property as part of your exchange. I'd like to just talk really quickly about some tips for a successful exchange. So whenever you do a 1031 exchange and you want to defer all of your capital gains taxes, the goal really is to buy a property that's equal or greater in value. So if you just wanted to reinvest your profits, if you bought a property for 100,000 and you sold it for 500, some people just want to reinvest that, take their capital back and reinvest their profit of 400. It just doesn't work that way, unfortunately. You're going to be taxed on your anything you do not reinvest. So it's important to find replacement property of equal or greater in value. The other goal is to use all of your cash proceeds. So, in that same scenario that you have, if you decide that you want to buy, John, I can hear you typing.
Sorry.
You want to mute? That's okay. If you want.
You could hear that.
I could. It's loud. It's right on the computer. But if you have to use all of your cash proceeds, so you can't go out and take on more debt and try to put some cash in your pocket. The other tip for a successful exchange is to have a continuity of taxpayer and title. So whoever the taxpayer is needs to be the purchaser of the replacement property. And we dig into that. We make sure that we know who the taxpayer is, whether you have a trust or a disregarded entity or a partnership. We dig into all of that to make sure that your exchange is set up properly. And lastly, and most importantly, you have to engage the qualified intermediary before the sale. So when you get a purchase and sale, when you engage or you find a buyer and you have a purchase and sale agreement, that's when you engage the qualified intermediary. If you do it after the fact, it's too late. You cannot close on a property and then decide to do an exchange afterwards. John or Sarah, do you want to kind of take this through and just kind of go through the taxes that are owed?
Okay. Do you want to throw up a slide on that, or?
Oh, can you not see my screen? I'm sorry. I'm not even showing my screen.
It's okay.
I apologize.
There we go.
That helps.
All right. Okay. So we've got taxes. When you sell any kind of property other than your primary residence, and of course you do have tax on your primary residence if you're making profit of more than 250 if you're single, or 500,000 if you're married. But on any other property other than your primary residence, when you sell it, you have to pay tax. And the taxes are listed on our slide here. And you can see it turns out to be a rather large chunk of the proceeds or the profit from the sale. Federal taxes are either 15 or 20%, depending on your tax bracket. And if you're in the highest tax bracket, you have to pay 20% capital gains tax. If you're in any of the other tax brackets, the lower tax brackets below the highest, then you pay 15% federal capital gains tax. The federal depreciation recapture is at 25%, and that depends on how much depreciation you've taken over the course of your ownership of the property. If you've owned it for many years, then the depreciation recapture can become a very huge number. Sarah?
Oh, okay. So we've got another federal tax at 3.8. That's the net investment income tax. People don't think about that one. And then we have the 4% Massachusetts state millionaire tax. Massachusetts, right? And I think that was, Michelle, was implemented this past year.
No,
Um,
it's been about 2 or 3 years now
2 years.
that they implemented that. Yeah, it's been a little bit now.
And then we've got another 5% on top of that for Massachusetts. So that's a
Yeah,
big,
so
big piece of the pie.
it does. It adds up really, really quickly. So, and unfortunately, a lot of our clients fall into that 4% Massachusetts millionaires tax just by selling a property. They kind of automatically fall into that because it's combined with your income. So if you chose not to exchange, a lot of our customers would be faced with that. Um, so, this is just, I wanted to just kind of display what an exchange looks like and kind of the role that we play and the role that everybody plays in this. So I know that we have some realtors and we have some attorneys on the call. So this will be really beneficial to you to kind of see how this works. So we have our taxpayer, our exchanger, our seller, whatever you want to call them, but our taxpayer will go ahead, list their property with their realtor the same as they normally would. And they're going to get into a contract, a purchase and sale agreement with the buyer. At the closing in Massachusetts, we are an attorney closing state. So at the closing in Massachusetts, we're going to have that deed directly deeded from our exchanger or our taxpayer directly to their buyer. The only difference is the attorney is going to, at the settlement, they're going to take the proceeds and they're going to wire it directly to the qualified intermediary. The taxpayer then is going to go out and find a replacement property. They're going to work with their realtor. They're going to put offers in on properties. We can certainly send deposits from the exchange proceeds to the purchase or to the seller for the purchase. And then same thing, they're going to get into contract. They're going to deed the property directly from the seller back to our taxpayer. And we're going to use those proceeds to purchase that property. So there is a time frame for all of that. You have 45 days to identify your replacement property. So from the time that you transfer title, this is the date that you're going to start. The clock's going to start ticking. You have 45 days to identify replacement properties, and you need to let us as the qualified intermediary know the properties that you want to identify and that you want to purchase. And then you have 180 days, again, from the closing, from your sale to purchase this replacement property. So 180 days is normally not the issue. It's normally the 45 days is where people kind of get a little hung up. That's, I think, probably the hardest part of the exchange is identifying replacement properties within that time frame. And some questions that people ask. One, they are calendar days. So if your 180th day falls on a holiday or if it falls on a Sunday, you need to close the Friday before. So, and there's really no exceptions to that. The only time that you'll see exceptions on these timeframes if there is a federally declared disaster and the IRS issues an extension. But if the house burns down that you're going to buy, or, you know, if there's something goes wrong with the inspection, if something happens, it doesn't matter. The IRS kind of doesn't care. You have to purchase one of your replacement properties or your exchange fails. The other question that we get often regarding the identifications is I just lost my train of thought with the addresses. Can you identify? There are very specific ways that you have to identify replacement properties. I don't think we're going too deep into that today, but we can work with you on those. You do not need to be in contract on your replacement property in order to make it qualify as a replacement identified property.
You just have to get it under contract at some point so that it doesn't get sold out from under you. If you don't have it under contract by the 45th day, you're taking a risk that your exchange is going to fall apart, because after the 45th day, if the property that you identified is sold, you can't go back and rename another property.
That's right. Yep, absolutely.
So very important.
It is. Yeah, I think that 45 days, don't you think that's really the hardest part for people, John?
Absolutely. We like to say you have 45 days plus the run-up period from the time you write the contract to sell your property until the closing of your property. So if you have a contract to sell your property and you have a good sized deposit, then you can start making offers on a replacement property even though you haven't closed your relinquished property. And that gives you an extended an extended shopping period.
Yes. Yeah. Agreed. I think that's kind of the advice we give everybody, is to make sure that they start shopping the moment they get a contract on the property that they're selling. And I think that that's best practices.
Yes, you can change. We don't actually, there's a question in the box there. We don't actually identify until your day 45. So you can change as much as you want up until day 45, but then after you can no longer change.
Yep. So there's, again, I'm going to just talk real quickly about the types of exchanges. And again, we get into deep dives every month. We do a webinar, and every month it's a deep dive into something else. So as we move forward through the year, we're going to do a deep dive into reverse exchanges. We're going to do a deep dive into improvement exchanges. Today, again, we're talking about vacation rentals. So we won't do a deep dive, but I do want to give you an overview. So, there's the two-party swap. I have a property that John wants. John has a property that I want, and we just swap it. Doesn't happen very often. It's not something that we see. We don't even necessarily need to get involved in it as qualified intermediaries, because it's not a scenario that happens a lot. What happens more often than not is that I have a property that, John's going to buy, and then I'm going to go ahead and I'm going to buy a property from another party. And that's when the qualified intermediary needs to be involved. So that's just called a delayed forward exchange. I'm selling to one party and then purchasing from a replacement property from another party. You can do your exchange in multiple sales and multiple acquisitions. So if you chose that you want to sell multiple properties and then purchase one larger asset, you can do that. And in reverse, you can certainly sell one property by multiple, sell multiple properties by one. Reverse exchanges, again, we're not going to get too deep into this today, but just so you know, in a market like a really hot market like it is now, you can certainly purchase a replacement property first, knowing that your relinquished property is going to sell quickly as soon as you put it on the market. So you can purchase a replacement property and then go ahead and sell your relinquished property afterwards. And that is an option called a reverse exchange. And lastly, there's the improvement exchange. The improvement exchange allows you to sell an asset and then purchase one of lesser value, use it, and then allowed to use your proceeds to improve that property. So you can sell for $1 million, buy for $800,000, and then use that additional $200,000 to improve that property.
You just have to make sure that that improvement is done by the time the 180th day rolls around.
That's right. Those are a little bit harder to do. We don't see too many improvement exchanges. Just because the values are so high now, people typically are buying higher priced properties anyway, so they don't even have money left over for improvements. But as you look towards your clients, especially if you are a realtor, these are the reasons that you are going to see your clients selling properties. We've got our younger investors. Those are the people that want to leverage up. They want to keep buying more properties. They want to be able to take advantage of the equity that's built in the property, using the money and buying more bigger, better properties. We've got, again, those younger investors looking to diversify, get into different asset classes, get into different market locations, and really starting to diversify, selling one asset and, splitting that equity up over multiple properties. And then we've got our older folks that want to consolidate. We've got the people that own, they've been building their assets for years and years and years. They have children that live across the country. They have a management burden, and they want to start consolidating, purchasing properties that may be easier to manage, that may be in a better location, that just may be all under one roof. So selling multiple condos and buying, one apartment building. Cash flow is always a big one. getting properties that cash flow better. Management relief, again, we see those older investors that want the management relief. And that's, Kent can talk for just a minute about DSTs when we're talking about management relief. Kent, can you give us a 30-second overview of what a DST is and how that might be able to help a client looking for management relief and cash flow?
Yeah, I mean, I think the best candidate for that is someone who no longer wants to be a hands-on active landlord. So, maybe there's a scenario where they're done being a landlord, they've got a great offer on a property, they talk to you, they learn all about this 1031 exchange, but they say, gee, I really don't want to have to replace debt for debt and equity for equity and go out and, go on through the underwriting process and all the rest of it. So maybe if they're looking to do something that is passive real estate, a Delaware statutory trust, which was really brought out in 2004 as a alternative to TICS or tenant in common, is a way of having fractionalized ownership in institutional property, and really someone else takes the role of being a property manager, landlord, taking care of the debt and property improvements, all of that. And so it's really more of a passive role. So and I always tell people, listen, it may not be what you want to do with all your assets, but maybe there's a combination between, maybe I want to downsize and buy a little rental property on the Cape and no longer have a multifamily in the city, but I can use a DST as kind of a catcher's mitt to maybe soak up some of the debt or equity that's not being allocated. So I don't know if that was too confusing.
Yeah, no, that's great. Can you just explain? Can you just tell them what a DST stands for?
Yeah, Delaware Statutory Trust.
Perfect. So, and we're going to do a deep dive into that too. So we're kind of sprinkling a lot of information at you, but we will be talking about DSTs later in the year. But certainly we have partners that we work with that are a wealth of knowledge in DSTs, Kent being one of them. So thank you, Kent. And now we are going to jump into vacation rentals. So John, do you want to talk about the safe harbor, the vacation rental safe harbor?
Absolutely. So
Okay,
back in 2008, the IRS issued a revenue procedure called 2008-16. A revenue procedure is just a guideline that the IRS issues so that it doesn't receive thousands, maybe tens of thousands, maybe hundreds of thousands of calls about a particular subject. And so the IRS was receiving back in 2005, 6, 7, and 8, they were receiving thousands of calls from clients or from citizens of the country. We have 350 million that the IRS has to oversee. And they were getting so many calls that they issued this revenue procedure to say, hey, if what is a second home versus a vacation, or a vacation home versus an investment property? So am I buying an investment property or am I buying a vacation home? Well, a vacation home is not 1031 exchangeable. A second home, sometimes people call them. But an investment property is 1031 exchangeable. Well, what if I wanted to buy a home in a vacation area and I wanted to use it some and I wanted to use it for rental income some? So the IRS agreed to publish this revenue procedure that creates a safe harbor for vacation home exchanges, and the IRS will consider a dwelling unit held for investment if certain requirements are met. And here are the requirements. The first one, the relinquished and the replacement properties are owned by the taxpayer for at least 24 months. In other words, it's talking about not only the replacement property, but the relinquished property as well. So if you're selling a property that you've owned for 24 months, then within each of the two 12-month periods, within the qualifying use period, the taxpayer must rent the property to another person or persons at fair market rental for 14 or more days. Family members qualify if they use the property as their primary residence. So what does that mean? If you've rented out your relinquished property for at least 14 days a year for the 2 years prior to the closing of that sale, then it would qualify as an investment property, as long as you have not used it for personal use for personal use greater than 14 days or 10% of the time it is rented. So in other words, you have to rent the property out for at least 14 days a year that you are trying to sell to have it classified as investment property rather than a second home. And you have to have limited your personal use to no more than 14 days per year. Now, if you were there for more than 14 days and the purpose that you were there for was to maintain or improve that property, like mowing the grass or painting the bathroom or, wallpapering the living room, then those days don't count towards your 14 days of personal use time.
How's the IRS going to know about that?
Sarah just asked a great question. Well, how does the IRS know what you're doing when you're there? And, the answer to that is they don't. But you have to have a reasonable argument if you stay there for more than 14 days a year. How will the IRS know that you've been staying there for longer than 14 days is a good question. Michelle?
Yeah, that's the question I think we get most often. People, and here's my answer to it. I don't want to try to sneak one over on the IRS. I personally don't feel comfortable with that. That's not something that I would do. So I'm going to just abide by the rules. I'm going to make sure that I rent out the property, and I'm going to make sure that I limit my use. It really is only 2 years. So it's not this huge amount of time that the safe harbor is requiring you to rent the property out. And the reality is that if you did get audited, if the IRS was looking at you and they did want to disqualify the exchange, could they find out? Yes, they're investigators. That's what the IRS does. They can investigate any sort of fraudulent cases, and they can find out.
I like to say the IRS has more power than the FBI. So if they wanted to track your telephone, they could probably do that. If you were spending the whole summer at the beach and you are in the mountains at your property, and you were remodeling that property and you spent a couple of $100,000 remodeling it, then you could have a good case that I didn't spend more than 14 days there for personal recreational purposes. I spent 3 months there because I had to look after the subcontractors that were coming in every day doing work on the property. That's acceptable, right?
Yes. And honestly, John, I don't think that for the average investor, it's easy to just say just keep records, keep good records, and then you'll be fine.
Yeah. So we've been talking about the relinquished property, the property that you're intending to sell. Is it a second home or is it an investment property? As long as you've rented it for more than 2 weeks a year and you've limited your personal use time, there's no question that it would be an investment property. Even if you used to stay at it before the last 2 years a lot, as long as during the last 2 years, you've limited your personal use, it qualifies. Now, let's move on to the replacement property.
Well, we can certainly talk about the replacement property. And I did put up on the screen, I put up one of the cases that disallowed an exchange, that disallowed when, the IRS disallowed the Barry Moore exchange because they did not abide by the safe harbor rules. So this happened in 2007. The taxpayer never rented, nor did he attempt to, these are the facts of the case. He never rented, nor did he attempt to rent the property. He deducted the mortgage interest, his home mortgage interest, rather as an investment interest expense. He probably went out and Brent can probably speak to this as a mortgage person, that there's a difference between a mortgage for a primary home and a mortgage for an investment property. Is that right, Brent?
Yes, correct. For the most part, the rate and terms will improve if it's a primary residence. in lenders look at kind of do the same thing here. Your address on your 1040 is your primary residence, and then you can claim the interest. So I think the IRS looks at it in a lot of ways that lenders look to verify what's your primary address, et cetera. Lenders will actually go into asking for specific utility bills for certain properties that are listed on the tax return. They'll dig pretty deep to figure out what is technically your primary residence, because we kind of do the same thing to make sure if someone's claiming the primary residence for better terms, that it is their actual primary residence.
Right. So I think people are more apt to say, oh, I'm gonna take a lesser rate because it's maybe a second home, as opposed to, I don't know if there's a difference in rate between second homes and investment properties, but all of these are considerations when you're doing an exchange.
Yeah, absolutely. And, sometimes we run into people that are saying, well, my mortgage banker said that I could get a better rate if I call this my primary residence, versus if I call it an investment property. And that is true. But then,
It's mortgage fraud.
who are you defrauding? You're either defrauding the IRS because you're saying that you're buying this property as a investment property, or you're defrauding the bank by telling the bank that you're buying it as a primary residence. There's a needle that you can thread that says that if you don't place the property with a rental management company and you rent it out yourself, then you could allow yourself to be getting a primary residence loan, but you could still rent out the property some if you wanted to. That's a very slippery slope to be on. And we generally just advise people, look, the difference in the rate is it's just a few bucks a month. And it's not worth getting in trouble with either the banking system or the IRS. Did you have another example there you wanted to talk about?
Yes, I think we wanted to just talk about some planning strategies for vacation homes. It's important to be able to substantiate your investment intent, making sure that this in fact is, and that goes back to getting a mortgage that is a mortgage that's classified as investment property. Taking out insurance, again, that is a non-owner occupied insurance policy. So all of these show your intention to be able to show your house as an investment property rather than a primary residence. Report the rental income and your attempts to rent the property. Sometimes it's a down market. Sometimes a hurricane blows through and you can't rent it for the season that you planned on renting it. But show those attempts to rent the property. Treat that property as a property that you hold for rental on your tax returns. Show the depreciation. Make sure that you're showing the improvements and the expenses and the capital expenses that you're putting into the property. Ensure that your HOA has a renter-friendly policy. There have been some cases that have come up, and literally it might have been this Moore case, but the HOA didn't even allow rentals to happen. So if your HOA doesn't allow rentals to happen, you certainly can't classify it as a rental property. And keeping a log of your personal use.
Yeah, we like to say keep a little pocket calendar. Those old-fashioned things that nobody uses anymore, and you get them free in the mail sometimes from people. Use a pocket calendar when you go to your vacation home that you bought as an investment property. Just note, if you're there for more than 14 days a year, just note what you're doing and how you're using your time, because you can certainly use the property yourself for 14 days, but if you use it for more than 14 days, you can just substantiate that someone was there doing something in your party. So here's what normally happens with me and Michelle. So Michelle, we buy a property together, and then and it's down at the shore, and so during the summer we want to go for more than 10 days. So you and I go down. You give me a list of honeydew items, and I'm involved in painting the bathroom and rewiring some of the electrical fixtures and mowing the lawn. And you're out on the beach with the kids and enjoying the place. Or maybe I'm on the beach and you're doing a spring cleaning on the property because the ladies that come in or the gentlemen that come in between tenants don't really do a deep clean. They just spritz it a little bit and they get it ready for the next rental client. So every so often, every few weeks, we may decide that we want to go down to do a deep spring clean for a weekend. And we could spend a lot of weekends at the shore and not violate our 14-day, as long as one of us is working on the property, improving or maintaining it. So can you use a vacation home as an investment property and 1031 exchange? And the answer is absolutely.
Yep. And we do a lot of them. We have a ton of people that are exchanging into properties in Maine, New Hampshire, the Cape, literally Florida. Florida was a really big one back in COVID days, but it's very, very popular here. People are trying to get out of that managed, two-family house in Somerville and get something that they may be able to enjoy a little bit, and then maybe even turn it into their retirement property eventually. So, once their safe harbor is done, once their 2 years is done and their exchange is old and cold, they can switch it over to their primary residence or their vacation home, or whatever they want. So there's a lot of flexibility there.
Michelle,
So
I was going to offer one other quick example
Yeah.
too. So
Of course.
if someone has let's say a long-term rental, in the city or whatnot, and maybe the long-term game plan is they want to have that vacation home that they plan on using, 3 years from now, personally up in the mountains or on the Cape or the, ocean, wherever it is. A lot of people will use that short-term rental loophole to basically be able to use material participation and use it as a deduction against active income. So the 1031 is a great way of moving, from maybe let's say a multifamily or industrial or triple net retail to maybe that property that I'm going to rent, 7 days or less. And what made me think about it is when John was talking about kind of tracking your use case, you need to track material participation as well. So if you got audited by the IRS, they're going to want to see, hey, show me some receipts. You didn't exceed that, 14 days personal use or 10% of the amount of time rented. But I think the 1031 is also a great way of doing some tax mitigation and maybe changing asset classes and then having a game plan that I'm going to convert that to a personal use at some point in the future.
Yeah, I love that. Yeah, you're always thinking of the other tax benefits, Kent.
Yeah.
Thank you. Does anybody have any questions? And we just threw a ton of information at you. Does anybody have any questions about the vacation rental or the 1031 exchange policy, 1031 exchange code in general? Feel free to turn on your cameras. Feel free to pop it in the chat, or you can just unmute yourself and ask a question. But otherwise, I just wanted to hit on just a couple things that we were talking about when we were talking about the vacation rentals. So fair market rent. If you are renting to a third party, you should just have fair market rent. And same if you're doing it to, John talked about, you have to rent it to a third party. And if you rent it to a related party, the related party needs to show it as their primary residence. So you can't just get off and say, oh, I'm going to rent this to my son for 2 weeks this year at $1,000 a week and think that you're going to satisfy your safe harbor IRS exchange, for the vacation rental. So if it's a related party, it needs to show as their primary residence, and a related party is your spouse, your children, your siblings, or like your grandparents, anybody in that ancestral lineage descent. And it does include your aunts and uncles, your nieces, your nephews, step parents, domestic partners, close friends. Those are not considered related parties. So I hope that kind of answers that question about related parties.
Yeah,
Any?
in-laws, husband of a sister can rent or can rent for a short period of time because they're not considered a related party. Sister could not rent from you, but your sister's husband could rent from you.
Yeah.
So
That's a good point. And we actually do a whole exchange on related parties too, because that plays into, even who you can purchase from. So we do, again, later in the year, we're going to do an exchange on related party exchange. We're going to do a webinar on related party exchanges. So that's a topic that we do a deep dive into. Any other questions? I know that there were a couple questions in the chat and we did answer those. If there's any questions about mortgages, they're going to go to Brent. Any questions about exchanges, you can reach out to myself or Joe, or Sarah or John. And I will put our information up. There are a few things that you need to know when you're looking to shop qualified intermediaries. So many of you we've worked with before, some of you we have not. So all QIs are not created equally. So it's important to know who you're hiring. As I said earlier, we are Northern Bank. As a wholly owned subsidiary of a bank, we are audited by a third party. We have the FDIC come in. So all of our funds processes, our procedures, they're all scrutinized to make sure that we are adhering to the strictest guidelines for the fund management. We do have fraud protection, and we are members of the Federation of Exchange Accommodators, which is the only trade association for qualified intermediaries in the country. We've been members since 2000. I've been a member since 2015 with Northern. I'm sure John's been a member a little bit longer. So we've been members of that association, which really sets our, sorry, again.
2003.
Okay. And they set our, what do you call it, John?
Ethical practices and
Yes.
guidelines of operation.
That's right.